Welcome to another episode of the Dana Yee Show. And this episode was inspired by an article that I read on Forbes titled "A Robinhood Trader May Face an $800,000 Tax Bill." I'll go through the article, explain what happened, explain why it happened, and what traders can do about it. And I'll have a link to this article in the description if you want to read it for yourself. Even if you're not an active trader, I think what I'm going to cover is really important to know, especially for tax purposes, so you should definitely stick around. They definitely don't teach this in school. I sometimes forget to include a disclaimer, but since I'm talking about specific tax codes and strategies, I want to make it clear that I'm not a tax or financial professional. I'm just a curious investor and trader who spent a lot of time reading the tax code and researching on Google and trying to learn more about these things. Side note, on this channel, I cover everything money and finance, so if you enjoy this video in particular, make sure to bop that like button, and if you want to see more, make sure to subscribe. Okay, so now on to the article. I'll sort of skip through and highlight what I think is important in this article. So as you know, a lot of new traders and investors joined the market in 2020, whether it be due to boredom or because everyone started talking about it. So a lot of people have been turning to the market sort of as a distraction for the pandemic. This can lead to unintended tax consequences, which can be pretty bad. So for example, in this case, a Robinhood new trader is facing a potential tax bill of $800,000 despite only making $45,000 in net trading profits. And as the article kind of says, this shows the importance of understanding complex trading rules and the tax implications of certain strategies. Unfortunately, taxes are really important and they don't really teach this in school. So this specific investor opened a new brokerage account in 2020 and they quickly scaled their trading. And this trader made between $200,000 and $2 million in trading volume per day. And on any given day, this seemed to be between 10 and 50 trades. So here is the shocking part. Their net profit, aka all of their gains minus all of their losses, were $45,000 by the year end. However, at the end of the year, when he received a 1099-B, which is the tax form that brokerages give you to fill out on your taxes and input into TurboTax, he had a $1.4 million capital gain and a tax bill of just over $800,000. So again, that's a tax bill of $800,000 on a profit of $45,000, which is a problem. Now, this is the important part. This poor soul traded all of the popular stocks, blah, 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 that doesn't matter, that's not the important part. But he never knew about the wash sale rule. This sentence here, which I'll explain in a little bit, he booked a profit but was disallowed all the losses because he never once waited the 30 days on those stocks to book the loss. And for a brief definition, the wash sale rule, again, really important, is an IRS regulation that prohibits someone from claiming a loss by selling and purchasing either the same or similar securities, which, fun to note, the IRS doesn't really strongly define what this means, within 30 days of the sale at a loss. And I'll give an example in a little bit. In fewer words and with an example, a wash sale occurs when an investor sells or trades a security at a loss and within 30 days before or after buys another one that is substantially similar. If you don't know, there is something called tax loss harvesting that some people will take advantage of at the end of the year, where they sell some stocks at a loss on purpose to be able to deduct the capital loss against their income. So for example, if they bought $10,000 of some company and at the end of the year it was worth $7,000. If they sold it, obviously this is a loss of $3,000, which means you can lower your taxable income. However, with a wash sale, if you buy before or after a loss within 30 days, you cannot use this loss. So what does that mean? Let's say I make $200 from a trade on, Tesla. Right? Fun stock. Everyone loves Tesla. And then I make another trade on Tesla and I lose $200. You would think that because your net profit is $0, you would be taxed $0. However, because of the wash sale rule, this loss, you cannot use it as a capital loss, which means you're taxed as if you made $200, even though you made $0. And this is exactly what happened to the Robinhood trader that I showed in the article a second ago. Another interesting thing to note is that the IRS says that you cannot buy a similar security before or after within 30 days, but what is substantially identical? I think they're purposefully ambiguous here, so you don't really know what causes a particular security to be substantially identical to another. But I think a general rule of thumb is if you're buying the exact same stock, that would be a substantially similar security because it's the same company. But beyond that, I can't say anything, and the IRS really isn't clear on what substantially identical even means. So this rule might seem kind of weird, but why is this rule in place? It's in place because sort of what I've covered before, it's to prevent taxpayers from claiming artificial losses. So again, in the example earlier, if I invested $10,000 into a company and it was only worth $7,000 at the end of the year, this is a $3,000 loss. However, if the wash sale weren't in place, you could sell for $7,000, locking in this $3,000 loss, allowing you to take this as a capital loss and then immediately buy back at $7,000. In which case, your stake in the company hasn't changed because before you sold, you had $7,000 in the company, and after you bought again, you had $7,000 in the company. But if the wash sale wasn't in place, you could essentially deduct $3,000 off your taxes by claiming this artificial loss. There are other ways to trigger the wash sale rule, so if you're unclear, I would definitely do some Googling or talk to a tax expert. And one other side note, this only applies to taxable accounts. So for example, the wash sale rule doesn't apply in a Roth IRA because you don't report those gains and losses to the IRS. Okay, that was scary. Now let's cover what you can do about it. First, and I suppose most obvious solution to this is wait at least 31 days before repurchasing. That would be the most basic way to get around the 30-day rule. Secondly, one other approach is instead of selling at a loss, if you still believe in the company long term, you can just buy more instead of selling. Again, on the caveat that you actually want to own the company long term. And lastly is a tax strategy. It's called the mark-to-market election. And this election is described in section 475F of the US tax code. So I am going to cover this briefly, what this election essentially is. And long story short, it essentially allows you to circumvent the wash sale rule. And again, this is what's known as a mark-to-market election, and it usually only applies to traders, so you have to make this election and sort of qualify for trader status. And this election goes to show that the tax treatment of people who buy and sell securities is not the same for all taxpayers, and it depends on if you're classified as a dealer, investor, or trader. I'm not going to cover dealer, but investor versus trader. Investing is buying and holding for the long term, 20, 30 years from now. And of course, a trader is going in and out of the market very quickly to capitalize on short-term movements in stock prices. And under the mark-to-market rules, dealers and eligible traders are treated as having sold all their securities on the last day of the tax year at their fair market value, causing gain or loss to be taken into account for the year. And then any gains or losses are ordinary income or ordinary losses. And this is really important here. Remember the example that I gave earlier? If you earn 200 on a single trade of a stock and lose 200 on the same stock, even though your net is zero, you'll be taxed as if you made 200 because of the wash sale rule. However, with mark-to-market elections, if you make 200 and then lose 200, your net gain, which is $0, is what you're going to be taxed on. So mark-to-market rules allows you to be taxed on your net profits based off of the entire year. And in this section, it's just showing that this election is not available if the taxpayer is considered an investor. However, one disadvantage of the mark-to-market election is that you are deemed to have sold all your stocks and securities for their fair market value on the last business day of the tax year. This is to say that unrealized gains will also be taxed even though you haven't sold the security because of this specific election. So for example, some traders have separate accounts, one where they only trade and maybe one where they invest, and the trading account can have the mark-to-market election, so they're only taxed on their net gains. And one other thing is that capital gains are not like classified as capital gains anymore, where they're taxed at the 15 or 20% bracket. This causes them to be taxed as ordinary income, in which you would pay potentially a much higher tax bracket for. Like a lot of legal or tax-like implications, there is a test, IRS test, to qualify for day trader status, essentially, and it takes into account things like trying to see profit from the daily market. I mean, who isn't trying to make money in the market? But whatever. The activity must be substantial, it must be continuous and regular, and they take things into account such as how long you hold stocks for, the frequency and the dollar amount of trades that you're putting in, the extent to which they pursue the activity to produce income, and the amount of time devoted to the activity. Though this is the test specified, they don't specify parameters for each of these. So for example, they don't define substantial, they don't define continuous, they don't define regular. So if you want to take take the selection, make sure to talk to a tax professional because I can't really give you much advice here. And I'll put a link below to this article about wash sales. I found it really informative and really helpful for myself. And again, I'm not a tax professional, so all of this information is based off of my own research, but wash sales are really important to know about, and especially if you plan on actively trading, it could lead to a really large tax bill that, of course, you do not want. As always, I hope you enjoyed the video, maybe learn something new, maybe learn something that can save you a lot in taxes, and I'll see you guys next time.